Here is what this session covers. Part A, Foundations, Definition, Objectives, Types, and Limitations. Part B, Institutional Roles and Accountability in Property Management. Part C, Control Activities across the property cycle. Part D, Monitoring, Physical Count, Reconciliation, and Follow-up. Part E, Legal and Regulatory Basis, Consolidated. Part F, 20 Common Misconceptions. Part G, 20 Pitfalls and Corrections. Part H, 20 Audit Deficiencies. Part 1, 15 Challenging Questions. Keep this structure in mind as we go. The first few parts build the theory and the roles, the middle parts get into concrete control, activities, and monitoring, and the final parts test what you have learned through misconceptions, pitfalls, real audit findings, and a set of challenging questions. Next slide. Part A, Foundations of Internal Control over PSMS. Why an agency's general internal control system, and not a separate one, is what actually governs its property. This first part lays the theoretical foundation everything else in the session builds on. What internal control actually is, what it is trying to achieve, the three types of control activity, and, just as importantly, where its limits are. Next slide. What internal control means when applied to property. An agency's internal control system is the collection of policies and procedures its management and personnel put in place to manage risk and give reasonable assurance that the agency's objectives will be met. It is not a document filed away, but a working process embedded in daily operations. When that system touches the property cycle, its job is to address the risks specific to each stage: a wrong acquisition decision, a mishandled delivery, an unsecured storeroom, an unauthorized issuance, an undocumented disposal, rather than to exist as some separate, parallel, property control system. This distinction matters practically. An agency does not need to invent new control machinery for its property function. It needs to make sure its existing internal control system actually reaches into that function with the same rigor it applies elsewhere. Now, in a bit more detail, here is the idea to hold on to. Your agency does not need a separate rulebook for property. The same internal control system that governs cash, payroll, and every other function is the one that has to reach into the property cycle. So when you're asked whether your office has internal control over property, the honest answer is really a question about whether your agency's existing control system is actually being applied with the same seriousness to acquisition, custody, issuance, and disposal as it is applied everywhere else. Next slide. The 4 general objectives read through a property lens. Operations. Are property resources actually being acquired, used, and maintained in a way that is economical, efficient, and effective, or is the agency simply accumulating items without a plan for their use? Reporting. Do the PPE and inventory figures in the financial statements actually match what a physical count would find, and are they produced on time? Compliance. Does every property transaction trace back to an authority under procurement law, the GAM, and the relevant commission on audit custodianship and disposal issuances? Safeguarding of assets. Is the property actually protected from unauthorized acquisition, use, or disposition, and from loss through waste, abuse, mismanagement, or fraud? Compliant, and was it safeguarded? If any one of the 4 fails, you have found something. Preventive control acts before anything goes wrong. For instance, a rule that no item leaves the warehouse without 2 signatures, or a policy that only the designated custodian holds a storeroom key. A detective control catches a problem that has already happened, early enough to still fix it. The clearest example is the annual physical count, which exposes a gap between the RPC PPE and the books before that gap grows any larger. Here is what this section covers. Part A, Foundations, Definition, Objectives, Types, and Limitations. Part B, Institutional Roles and Accountability in Property Management. Part C, Control Activities across the property cycle. Part D, Monitoring, Physical Count, Reconciliation, and Follow-up. Part E, Legal and Regulatory Basis, Consolidated. Part F, 20 Common Misconceptions. Part G, 20 pitfalls and corrections. Part H, 20 audit deficiencies. Part 1, 15 challenging questions. Keep this structure in mind as we go. The first few parts build the theory and the roles, the middle parts get into concrete control, activities and monitoring, and the final parts test what you have learned through misconceptions, pitfalls, real audit findings, and a set of challenging questions. Next slide. Part A, Foundations of Internal Control over PSMS. Why an agency's general internal control system, and not a separate one, is what actually governs its property. This first part lays the theoretical foundation everything else in the session builds on. What internal control actually is, what it is trying to achieve, the three types of control activity, and, just as importantly, where its limits are. Next slide. What internal control means when applied to property. An agency's internal control system is the collection of policies and procedures its management and personnel put in place to manage risk and give reasonable assurance that the agency's objectives will be met. It is not a document filed away, but a working process embedded in daily operations. When that system touches the property cycle, its job is to address the risks specific to each stage: a wrong acquisition decision, a mishandled delivery, an unsecured storeroom, an unauthorized issuance, an undocumented disposal, rather than to exist as some separate, parallel, property control system. This distinction matters practically. An agency does not need to invent new control machinery for its property function. It needs to make sure its existing internal control system actually reaches into that function with the same rigor it applies elsewhere. Now, in a bit more detail, here is the idea to hold on to. Your agency does not need a separate rulebook for property. The same internal control system that governs cash, payroll, and every other function is the one that has to reach into the property cycle. So when you're asked whether your office has internal control over property, the honest answer is really a question about whether your agency's existing control system is actually being applied with the same seriousness to acquisition, custody, issuance, and disposal as it is applied everywhere else. Next slide. The 4 general objectives read through a property lens. Operations. Are property resources actually being acquired, used, and maintained in a way that is economical, efficient, and effective, or is the agency simply accumulating items without a plan for their use? Reporting. Do the PPE and inventory figures in the financial statements actually match what a physical count would find, and are they produced on time? Compliance. Does every property transaction trace back to an authority under procurement law, the GAM, and the relevant commission on audit custodianship and disposal issuances? Safeguarding of assets. Is the property actually protected from unauthorized acquisition, use, or disposition, and from loss through waste, abuse, mismanagement, or fraud, not just nominally, but in practice? Now, in a bit more detail. Notice that these 4 objectives are not exclusive to property. They are the 4 general objectives of internal control for the whole agency, simply read through a property lens. A useful exercise for any auditor is to take a specific property transaction you are reviewing and ask all 4 questions of it in turn. Was it economical? Will it report correctly? Was it compliant? And was it safeguarded? If any one of the 4 fails, you have found something worth writing up. Next slide. 3 kinds of control, illustrated with property examples. A preventive control acts before anything goes wrong, for instance, a rule that no item leaves the warehouse without 2 signatures, or a policy that only the designated custodian holds a storeroom key. A detective control catches a problem that has already happened, early enough to still fix it. The clearest example is the annual physical count, which exposes a gap between the RPC PPE and the books before that gap grows any larger. A corrective control resolves a problem once it has been detected and confirmed. The formal request for relief from property accountability, filed once an investigated loss is established, is this type of control in action. None of the 3 substitutes for the other 2, an agency relying only on the yearly count, detective, while skipping segregation of duties, preventive, is simply choosing to find out about losses later rather than prevent them. Now, in a bit more detail, the exam-style trap here is assuming that any one of these 3 types is enough on its own. It is not. A preventive control without a detective control means errors can persist for a long time before anyone notices. A detective control without a preventive control means the agency is choosing to find out about losses after the fact, every single time. And the corrective control without the other 2 simply means the agency is good at cleaning up messes it never learned to prevent. Next slide. Tip. A discrepancy found in the count is already a cost. By the time an annual physical count surfaces a shortage, the agency has already absorbed the cost of the missing asset, the staff time needed to investigate it, and the paperwork needed to explain it. Strengthening preventive controls at the point of custody, segregation of duties, authorization, restricted access, is consistently cheaper than waiting for the count to do the preventive work retroactively. In a bit more detail, the point being made here is about timing and cost, not just about being careful. By the time the annual count catches a shortage, the agency has already lost the asset, spent staff time investigating, and generated paperwork to explain it. Preventive controls are always cheaper because they act before any of those three costs are incurred. Next slide. Where internal control runs into its own limits. No control system, however well designed, can promise certainty, only reasonable assurance, because the people operating it are still capable of misjudgment, for example in estimating an asset's remaining useful life. Two or more people acting together can defeat almost any control on paper. A custodian and a records officer who agree to hide a shortage are not stopped by segregation of duties on an organizational chart alone. Management itself can override a control it does not like. Ordering a release of property without the required paperwork is a management decision, not a system failure, and no control policy can force compliance from the very people who could rewrite it. A control that fit the agency 5 reorganizations ago may no longer fit it today. Controls age out of relevance if nobody revisits them. Finally, controls cost something to run, and an agency is never expected to spend more guarding an item than the item itself is worth. Now, in a bit more detail, this is one of the most frequently tested ideas in this whole topic, because it is counterintuitive. Students often assume that a good internal control system means losses cannot happen. The correct position, and the one Commission on Audit actually expects you to hold, is that internal control reduces risk to a reasonable level, never to zero. Collusion, management override, human error, obsolescence, and cost-benefit limits are the 5 reasons why, and you should be able to name all 5. Next slide. Why this topic deserves its own emphasis. PPE is typically one of the largest line items on an agency's or LGU's statement of financial position, so a weakness here does not stay small, it distorts the whole set of financial statements. Unlike cash or budget controls, property is a physical thing that can be carried away, damaged, or left to rot in storage. The control emphasis has to be physical, not just procedural. A functioning control system is also what stands between an individual accountable officer and personal liability for a loss under the Government Auditing Code. Good controls protect people, not just numbers. Property-related findings are among the most frequently repeated items across successive annual audit reports for LGUs, NGAs, and GOCCs alike, which suggests the underlying weaknesses are structural rather than incidental. Now, in a bit more detail, 4 separate reasons are given here, and it is worth being able to reproduce all 4 rather than just one, because exam questions on why does internal control over property matter are often looking for more than a single answer: the size of PPE on the balance sheet, the physical vulnerability of property compared to cash, the personal liability protection controls provide to individual officers, and the fact that property findings keep recurring in audit reports. Next slide. Here is the text of the provision, read exactly as written. Every officer of any government agency whose duties permit or require the possession or custody of government funds or property shall be accountable therefor and for the safekeeping thereof in conformity with law. In a bit more detail, in plain language, this provision means that the moment your job duties give you possession or custody of government property, the law automatically makes you accountable for keeping it safe. You do not need a separate memo naming you an accountable officer, the accountability follows the duties themselves. Next slide. The levels at which property control actually operates. At the operating unit level, the field office, division, or warehouse is where property is physically received, stored, released, and used, and where most control activity actually happens day to day. At the management review level, supervisors and office heads authorize transactions, read the reports, and enforce accountability when something goes wrong. At the top, the local chief executive, department secretary, or head of agency bears ultimate responsibility for having installed an adequate control system in the first place, including over property. Where an internal audit function exists, it sits apart from all 3, offering an independent check on whether the control design actually works as intended. Now, in a bit more detail, Picture this as 4 concentric layers, from the ground up. The operating unit doing the actual physical work, management review supervising it, the head of agency who is ultimately accountable for the whole system, an internal audit sitting outside all 3, checking whether the design is sound. A common mistake is collapsing these into just 2 layers, the property officer and the boss. The framework actually expects 4 distinct layers to be functioning. Next slide. Part B, Institutional Roles and Accountability. Who answers for what in the property cycle, and how personal liability actually attaches. This part shifts from theory to people. Who is actually responsible for property at each level of the organization, and how personal liability attaches to specific individuals under the law. Next slide. The head of agency cannot delegate away ultimate responsibility. Whether the title is local chief executive, department secretary, or agency president or CEO, the law places responsibility for installing a sound internal control system, property included, squarely on the head of the agency. Assigning day-to-day custody or record keeping to a property or supply officer moves the operational work, not the underlying responsibility. The head of agency's accountability for the adequacy of the system remains. That accountability is also legally distinct from, not a substitute for, whatever personal liability the individual custodian in physical possession of the property may separately incur. Now, in a bit more detail, the single most important sentence on this slide is that responsibility and personal liability are legally distinct things. The head of agency's responsibility for the adequacy of the whole control system never disappears, no matter how far down the organization actual custody has been delegated. If you remember only one point from this part of the session, remember that delegation moves the work, not the responsibility. Next slide. 2 categories of personal liability. An accountable officer is anyone whose duties give them possession or custody of government property, and who is therefore answerable for its safekeeping under the bonding requirement of the Government Auditing Code. A responsible officer, in commission on audits usage, need not be in physical custody at all. Direct supervisory or approving authority over a property transaction is enough to create shared liability if that transaction turns out to be irregular. Either category can end up personally liable for the value of property lost through negligence in their care, though that liability is never automatic. It is tested through the formal request for relief process. Now, in a bit more detail, pay close attention to the difference between these 2 categories, because it is a classic point of confusion. An accountable officer must physically hold the property. A responsible officer does not have to touch it at all. Supervisory or approving authority over the transaction is enough. Both can end up personally liable, but for different reasons, one for custody, the other for the decision. Next slide. The property or supply officer's actual job description. Custody and record keeping come first, maintaining the property card and stock card for everything the office is accountable for. Every issuance to an end user must be captured on an inventory custodian slip or property acknowledgement receipt before the item actually changes hands. Once a year, at minimum, this officer coordinates the physical count with the inventory committee and reconciles what was counted against what the books say. In an LGU, this function typically sits with the General Services Office under RA number 7160. In an NGA, it is usually the supply or property section within the administrative division. Now, in a bit more detail, if you were ever asked to describe what a property or supply officer actually does day to day, this is the answer in 4 parts. Keeping the property card and stock card current, capturing every issuance on the correct form before the item changes hands, running the annual count with the inventory committee, and reconciling what was counted against what the books say. Everything else in this course builds on these 4 functions. Next slide. Inspection and custody have to stay separate people. Inspection and acceptance exists to verify, before the agency takes the item into its books, that the delivery actually matches its specifications, quantity, and condition. Custodianship begins only once that verification is done, and covers everything from that point, safekeeping and eventual issuance. If the same individual or unit performs both roles, the independent check that inspection is supposed to provide disappears. This single combination is one of the more common segregation of duties failures found in property audits. Now, in a bit more detail, this is one of the most commonly violated rules in actual government offices, precisely because it seems efficient to let the same person both check a delivery and then keep it. Resist that instinct. The moment inspection and custody sit with the same person, the independent check that inspection exists to provide is gone, and no amount of good faith on that person's part can restore it. Next slide. The Inventory Committee's narrow but essential mandate. It exists by formal act of the head of agency, for one purpose: physically counting PPE. Its output is the completed inventory count form and the consolidated RPC PPE, not merely a walkthrough, but a documented count with tagging and condition notes for every item. Its members should not be the same people who hold day-to-day custody of the items being counted, otherwise the count is really just the custodian checking their own work, which defeats its purpose as a detective control. Now, in a bit more detail, notice the very specific and narrow purpose here. This committee exists for one job: physically counting PPE, and its members should not be the custodians of the items being counted. If the custodian is on the counting committee for their own items, you no longer have an independent detective control. You have the custodian checking their own homework. Next slide. Warning: the Commission on Audit auditor designs nothing, they only test it. It is a mistake to treat the annual Commission on Audit as the agency's property control system. The auditor's job is to independently evaluate whether the agency's own controls are adequate and working, not to supply those controls in the auditor's absence. An agency that only discovers property problems when Commission on Audit points them out effectively has no internal control system of its own. It has simply outsourced the discovery function to someone whose job was only ever to check, not to build. In a bit more detail, this warning corrects a very common misunderstanding among agency staff, who sometimes treat the yearly Commission on Audit visit as though it were their internal control system. It is not. The auditor's role is strictly to test whether the agency's own system works. An agency that only learns about its property problems from Commission on Audit has, in effect, no internal control system of its own. Next slide. Part C. Control activities across the property cycle. The concrete, stage-by-stage activities a control system needs to actually perform. This part gets into the concrete, day-to-day mechanics, the specific activities, segregation of duties, authorization, physical controls, documentation, and reconciliation that make internal control real rather than theoretical. Next slide. Segregation of duties, stage by stage. The person who identifies a need, requisitioning, should not be the same person who approves buying it. The person who verifies a delivery, receiving, or inspection should not be the same person who then keeps custody of it. The person holding custody should not be the same person maintaining that item's property card. The property officer's own records should be reconciled against, not merged into, the accounting officer's books. Whoever authorizes a disposal should not be the one who physically carries it out or personally benefits from it. Separation slowly, because each one maps to a specific point of failure. Auditors look for requisitioning versus approving, receiving versus custody, custody versus record keeping, property office versus accounting office, and disposal authorization versus disposal execution. If you can name all 5 separations and explain what goes wrong when each one collapses, you have mastered this slide. Next slide. What authorization actually requires? Every acquisition, transfer, issuance, or disposal needs documented sign-off from someone with delegated authority for that specific kind of transaction, not a general sense that someone senior knows about it. PSO thresholds that trigger higher-level approval should be written down somewhere, in the agency's internal control policy or its delegation of authority issuance, not left to memory or custom. An authorization given verbally, or given after the transaction has already happened, does not function as a control at all, because it provides no opportunity to stop anything before it occurs. Now, in a bit more detail, the test here is not whether an authorization exists in some general sense, but whether it is documented, tied to a specific threshold, and given before the transaction, not after. A verbal go-ahead from a supervisor, however well-intentioned, does not satisfy any of these 3 requirements, and that is precisely why it does not count as a control. Next slide. Physical controls that actually protect the asset. Access to storerooms and warehouses should be limited to named individuals, not left open to whoever happens to have a key. Every item should carry a unique tag or marking that ties it back to its property card entry. Without this, a physical count cannot reliably match what it finds to what the books say. The storage environment itself needs safeguards proportionate to what is inside it. fire, flood, pests, and theft each pose a different risk depending on what is stored and where. Scheduled counts should be supplemented by occasional, unannounced spot checks. A control that is only ever tested on a known date is a control someone can prepare for. Now, in a bit more detail. These 4 physical controls work together: restricted access, unique tagging, environment-appropriate safeguards, and unannounced spot checks. The spot checkpoint is worth remembering specifically, because a control that only ever gets tested on a predictable schedule is a control that can be prepared for in advance, which defeats much of its purpose. Next slide. The paper trail is itself a control, not just a record of one. A PAR or IC transfers custody to a specific individual and, in doing so, creates that individual's personal accountability for the item. The property card, kept by the property office, tracks every movement of a specific piece of PPE across its life. The stock card or semi-expendable property card performs the same function for supplies and lower value items, and applies regardless of whether the item meets a capitalization threshold. The RPC PPE is the formal, reconciled output of the annual count, the point where the physical world and the books are required to agree, or to explain why they do not. None of these documents merely records history after the fact. Each one exists to make a specific decision, event, or transaction verifiable later. Now, in a bit more detail. The key reframe on this slide is that documentation is not merely evidence that a control happened, the act of creating the document is itself the control. A PAR does not just record that custody transferred, signing it is the moment accountability is actually established. Keep that distinction in mind. Form completion is a control activity, not paperwork that follows one. Next slide. Caution. A signature only means something if it followed a check. A custodian who signs a PAR or ICs before the receiving employee has actually verified the item against the form has produced a document that looks complete but proves nothing. The sequence matters. Check first, sign second. Reversing it turns a control into a formality. In a bit more detail, the caution here is about sequencing, not about paperwork completeness. A signed form proves nothing if the check it was supposed to represent never actually happened first. Always think of the signature as the last step, not the first. Next slide. Verification and reconciliation are 2 different checks. Verification confirms that a recorded transaction or balance actually corresponds to something real. This is the entire point of the physical count. Reconciliation is a separate comparison. The property office's property card against the accounting office's general ledger balance for PPE, done to confirm the 2 independently maintained records still agree. This comparison should happen on a regular schedule, commonly quarterly, rather than only surfacing once a year, right before the count or right before an audit visit. A variance between the 2 records is itself a finding worth investigating, even before anyone determines whether an actual loss occurred. An unexplained gap is a control weakness in its own right. Now, in a bit more detail. Do not treat verification and reconciliation as synonyms, they check different things. Verification asks whether a recorded item actually exists. Reconciliation asks whether 2 independently kept sets of records still agree with each other. An agency can pass one of these checks and fail the other, so both need to happen, and on a regular schedule rather than only once a year. Next slide. Part D. Monitoring, physical count, reconciliation, and follow-up. How an agency actually finds out whether the controls described in Part C are working. This part explains how an agency actually finds out whether everything covered in Part C is working. The annual physical count, what to do when it turns up a problem, and the broader concept of monitoring. Next slide. The annual physical count is not optional or one-time. Every agency must physically count all its PPE, purchased, donated, or built by administration, found at its stations, every year, without exception for a quiet year with no reported losses. The head of agency creates an inventory committee that completes an inventory count form for each PPE sub-major account group and consolidates the results into the RPC PPE. Because this obligation recurs every year, a single completed count from a prior period never substitutes for the current year's count. Each cycle stands on its own. Now, in a bit more detail. 2 words matter most on this slide: annual and every. The count is not a discretionary best practice, it is a standing legal requirement that recurs every single year regardless of whether the prior year was uneventful, and it covers all PPE, however it was acquired, found at every station the agency operates. Next slide. What happens the moment a discrepancy turns up? A shortfall, or an item physically present but never previously recorded, triggers an investigation first. It is never simply written into or out of the books on the spot. An unrecorded item found at station may still be recognized, but only with evidence of ownership and a defensible fair value estimate, following the specific recognition procedure the circular sets out. Where an item is confirmed missing, the custodian owes an explanation, and, if loss is confirmed, the accountable officer must go through the formal relief from accountability process before that item is finally taken off the books. Now, in a bit more detail. This slide describes a strict three-step sequence that is frequently tested. Investigate first, then apply the specific recognition procedure if the item is found but unrecorded, and only proceed to a formal request for relief from accountability if a loss is actually confirmed. Skipping straight to writing an item on or off the books without going through this sequence is the error auditors most often flag. Next slide. Monitoring is not the same thing as the annual count. Monitoring is one of the 5 components that make up an internal control system alongside the control environment, risk assessment, control activities, and information and communication. It is a continuous state, not a once-a-year event. For property specifically, monitoring includes ordinary supervisory oversight, the periodic reconciliation described in Part C, the annual count, and genuine follow-through on whatever a prior audit recommended. When the same property finding shows up again and again across successive annual audit reports, that repetition is itself evidence that this particular component, monitoring, is not functioning, whatever else the agency may be doing right. Now, in a bit more detail. This is a distinction worth holding on to carefully. The annual physical count is one specific monitoring activity, but monitoring itself is a continuous, 5-component-wide function that also includes ordinary supervision, periodic reconciliation, and genuine follow-through on prior audit findings. A recurring finding across several years of audit reports is really evidence that this broader monitoring function, not just the yearly count, has broken down. Next slide. Part E, Legal and Regulatory Basis. The primary issuances underlying every provision cited in this session, consolidated for reference. This part consolidates every legal citation used throughout the session into one place, for quick reference. Next slide. Consolidated Legal and Regulatory Basis, 1 of 2. 1987 Philippine Constitution, Article 9D, creates the Commission on Audit and its authority to examine, audit, and settle government accounts, including those pertaining to property. Presidential Decree No. 1445, Government Auditing Code of the Philippines, Sections 4, 73, 101 to 108 on accountability for and safekeeping of government property, and relief from accountability. Commission on Audit Circular No. 2018-003, promulgates the Internal Control Standards for the Philippine Public Sector, ICSPPs, and the Internal Audit Standards for the Philippine Public Sector, IASPPs. Commission on Audit Circular No. 2020-006, January 31, 2020, Guidelines and Procedures in the Conduct of Physical Count of PPE, Recognition of PPE Items Found at Station, and Disposition for Non-Existing or Missing PPE Items. Now, in a bit more detail. Take a moment to connect this back to the general principle introduced earlier in this part, since that is the thread tying every slide in this section together. Next slide. Consolidated Legal and Regulatory Basis, 2 of 2. Government Accounting Manual, GAM, for National Government Agencies, Volumes I and II, Accounting Policies and Prescribed Forms, Registries, and Reports for Property, Plant and Equipment. Republic Act No. 7160, Local Government Code of 1991, Sections 340, 474, B, 490, LGU Officials Accountability for Funds and Property, and the General Services Office function. Revised Philippine Government Internal Audit Manual RPGIAM, DBM Circular Letter No. 2028, Internal Audit's Role in Evaluating Internal Control, including over property, across the public sector. Now, in a bit more detail. Take a moment to connect this back to the general principle introduced earlier in this part, since that is the thread tying every slide in this section together. Next slide. Part F, 20 Common Misconceptions. Each entry pairs a commonly held but incorrect belief with the accurate rule and its legal basis. This part tests your understanding by presenting 20 commonly held but incorrect beliefs about internal control over property, each paired with the accurate rule. Next slide. 20 common misconceptions. Number 1. Myth. Internal control over property is solely the internal audit unit's responsibility. Fact. Internal control is a shared responsibility of all officials and employees who take part in the property cycle, not the internal audit unit alone. Number 2. Myth. A property or supply officer may requisition, receive, and record property with no other officer's participation. Fact. Segregation of duties requires that requisitioning, receiving, and recording be handled by different offices or units. Next slide. 20 common misconceptions. Number 3. Myth. Effective internal control guarantees that government property will never be lost. Fact. Internal control provides only reasonable, not absolute, assurance because of its inherent limitations. Number 4. Myth. Internal control applies only to property, plant and equipment, not to low-value or semi-expendable items. Fact. Internal control and property record keeping apply to all government property regardless of unit value or capitalization threshold. Next slide. 20 common misconceptions. Number 5. Myth. A signed PAR or ICs is optional paperwork that can be completed later if convenient. Fact. Issuance documentation is itself a control activity that establishes individual accountability at the moment property changes hands. Number 6. Myth. The annual physical count of PPE may be skipped if no losses have been reported. Fact. The annual physical count is a standing, mandatory requirement regardless of whether losses have been reported. Next slide. 20 common misconceptions. Number 7. Myth. Reconciling the property card against the general ledger is purely an accounting office task. Fact. Reconciliation is a joint responsibility of the property office and the accounting office, performed as a shared monitoring control. Number 8. Myth. Internal control weaknesses over property only matter when Commission on Audit is conducting its audit. Fact. Internal control is a continuous management responsibility that operates independently of the audit cycle. Next slide. 20 common misconceptions. Number 9. Myth. A supervisor's verbal go-ahead is sufficient authorization for a property transaction. Fact. Authorization must be documented in writing as a control activity that can later be verified. Number 10. Myth. Once the RPCPPE is submitted, no further action on the count is needed. Fact. The RPCPPE is a snapshot. Any discrepancy it reveals must still be investigated and the records updated afterward. Next slide. 20 common misconceptions. Number 11. Myth. The head of agency's accountability for property ends once a property officer is designated. Fact. The head of agency retains overall responsibility for the adequacy of the control system, without prejudice to the designated officer's own personal liability. Number 12. Myth. Internal control over property is a paperwork requirement unrelated to fraud prevention. Fact. Safeguarding of assets against fraud, waste, and loss is one of the 4 general objectives of internal control. Next slide. 20 common misconceptions. Number 13. Myth. Detective controls such as audits and counts matter more than preventive controls for property. Fact. Preventive, detective, and corrective controls are complementary. None substitutes for the others. Number 14. Myth. Weaknesses in the general control environment have no bearing on property-specific controls. Fact. The control environment is the foundation component that directly affects how effectively all other controls, including property controls, actually operate. Next slide. 20 common misconceptions. Number 15. Myth. Small LGUs are exempt from establishing internal control and internal audit over property because of their size. Fact. The requirement to maintain internal control, and to establish an internal audit function, applies to LGUs regardless of income class or size. Number 16. Myth. Reviewing property control only happens during turnover of accountability from one officer to another. Fact. Monitoring of property controls should be continuous, not confined to turnover events. Next slide. 20 common misconceptions. Number 17. Myth. An informal personal logbook kept by the custodian satisfies property record-keeping requirements. Fact. Official, prescribed forms and registries, the property card, stock card, and related GAM prescribed forms, are required. Number 18. Myth. Risk assessment for property loss is a one-time exercise done only when the control system is first set up. Fact: risk assessment is an ongoing process that must respond to changing circumstances, such as new storage locations or new property types. Next slide. 20 common misconceptions. Number 19. Myth: only the Commission on Audit auditor can identify internal control weaknesses over property. Fact: management bears the primary responsibility to identify and correct its own control weaknesses through ongoing self-assessment. Number 20. Myth: internal control activities that were adequate when first put in place remain adequate indefinitely. Fact: internal control has inherent limitations, including obsolescence from organizational or procedural change, and must be periodically reviewed and updated. Next slide. Part G. 20 pitfalls and corrections. Recurring operational weaknesses observed in property cycle internal control, and how to correct each one. This part shifts from beliefs to behavior. 20 recurring operational mistakes actually seen in government offices, and the specific correction for each one. Next slide. 20 pitfalls and corrections. Number 1. Pitfall: one person acts as both custodian and record keeper of the same property. Correction: separate the custodial, physical possession, function from the record-keeping function, per the segregation of duties principle. Number 2. Pitfall: property cards are updated only once a year, at year-end. Correction: update property cards contemporaneously with every receipt, issue, transfer, or disposal so records stay current for reconciliation. Next slide. 20 pitfalls and corrections. Number 3. Pitfall: no annual physical inventory has been conducted for several years running. Correction: conduct and document the annual physical count through a formally organized inventory committee, as required. Number 4. Pitfall: discrepancies between the physical count and book records are noted but never investigated. Correction: establish a documented variance investigation and record adjustment procedure to be completed immediately after every count. Next slide. 20 pitfalls and corrections. Number 5. Pitfall: equipment is released to end users without assigned ICs or PAR. Correction: require assigned ICs or PAR before releasing custody, so individual accountability is established at the point of transfer. Number 6. Pitfall: the agency has no written internal control policy specific to the property cycle. Correction: formalize property cycle control policies consistent with the agency's overall internal control system under the ICSPPs. Next slide. 20 pitfalls and corrections. Number 7. Pitfall: storeroom or warehouse access is unrestricted, with multiple personnel holding keys. Correction: limit and log physical access to a single designated custodian, supplemented by periodic spot checks. Number 8. Pitfall: property and accounting records are reconciled only when Commission on Audit specifically asks for it. Correction: institutionalize periodic, at minimum quarterly, reconciliation between the property card and the general ledger as a standing control. Next slide. 20 pitfalls and corrections. Number 9. Pitfall: new employees receive equipment before being oriented on their property accountability. Correction: require a signed acknowledgement of accountability, together with basic orientation, before any property is issued. Number 10. Pitfall: the same committee both inspects and accepts deliveries and also serves as property custodian. Correction: keep the receiving or inspection function independent of the custody and record-keeping functions. Next slide. 20 pitfalls and corrections. Number 11. Pitfall: turnover of accountability when an officer transfers or resigns is undocumented. Correction: require a formal clearance and turnover procedure, with assigned inventory, before relieving an accountable officer of duty. Number 12. Pitfall: property releases rely on informal trust rather than documented authorization. Correction: require written, sequentially numbered authorization or issue slips for every release of property from custody. Next slide. 20 pitfalls and corrections. Number 13. Pitfall: no formal risk assessment for property loss, theft, fire, flood, has ever been conducted. Correction: conduct and document a periodic risk assessment covering property safeguarding risks, and let it inform the design of control activities. Number 14. Pitfall: semi-expendable items are tracked informally, or not at all, because they fall below the capitalization threshold. Correction. Maintain a semi-expendable property card or stock card regardless of capitalization threshold. Accountability, not capitalized value, is the trigger. Next slide. 20 pitfalls and corrections. Number 15. Pitfall. Monitoring of property controls is left entirely to the yearly Commission on Audit. Correction. Establish a management-level review mechanism, such as internal audit, where established, independent of the external audit cycle. Number 16. Pitfall. Written control procedures exist on paper but are not actually followed day to day. Correction. Periodically test the operating effectiveness of controls, not just their design, through walkthroughs or internal review. Next slide. 20 pitfalls and corrections. Number 17. Pitfall. A single officer both approves the procurement of an item and receives or accepts its delivery. Correction. Separate the approving authority for acquisition from the receiving and acceptance function. Number 18. Pitfall. Lost or missing property is informally written off without following the relief process. Correction. Follow the formal request for relief from property accountability procedure before any derecognition or write-off. Next slide. 20 pitfalls and corrections. Number 19. Pitfall. Property records exist in only one format, manual or electronic, with no backup copy. Correction. Maintain both a working set and a secure backup, physical or electronic, of all property records. Number 20. Pitfall. Job descriptions do not clearly state who is accountable for property in each office or unit. Correction. Formally designate and document the accountable or responsible officer for each unit's property holdings. Next slide. Part H. 20 audit deficiencies. Findings typically raised in audit observation memoranda concerning internal control over property, matched to the provision each violates. This part presents 20 audit findings in the exact style you will see in a real audit observation memorandum, each tied to the provision it violates. Next slide. 20 audit deficiencies. Number 1. Deficiency. Absence of segregation of duties between custodianship and record-keeping of property. Number 2. Deficiency. Non-conduct of the mandatory annual physical inventory of PPE. Next slide. 20 audit deficiencies. Number 3. Deficiency. Unreconciled variance between property card balances and general ledger PPE balances. Number 4. Deficiency. Missing or incomplete ICs or PAR for issued equipment, precluding individual accountability. Next slide. 20 audit deficiencies. Number 5. Deficiency. Absent or outdated agency-specific internal control policies over property management. Number 6. Deficiency. No inventory committee formally organized to conduct the required physical count. Next slide. 20 audit deficiencies. Number 7. Deficiency. The property custodian also performs the record-keeping function for the same items. Number 8. Deficiency. Missing PPE items still carried in the books without a documented request for relief from accountability. Next slide. 20 audit deficiencies. Number 9. Deficiency. Semi-expendable property issued to end users is not covered by any property or stock card. Number 10. Deficiency. No documented risk assessment covering property safeguarding risks. Next slide. 20 audit deficiencies. Number 11. Deficiency. No turnover or clearance documentation on change of an accountable officer. Number 12. Deficiency. Weak physical access controls over storerooms or warehouses, unrestricted key access. Next slide. 20 audit deficiencies. Number 13. Deficiency. Prior year's audit recommendations on property internal control remain unimplemented. Number 14. Deficiency. Authorization for release or transfer of property is verbal or undocumented. Next slide. 20 audit deficiencies. Number 15. Deficiency. Property records are kept in unofficial formats inconsistent with GAM prescribed forms. Number 16. Deficiency. No management-level self-assessment of internal control over property has been performed. Next slide. 20 audit deficiencies. Number 17. Deficiency. Discrepancies noted during the physical count remain unresolved beyond a reasonable period. Number 18. Deficiency. No designation order formally naming the accountable or responsible officer for a unit's property. Next slide. 20 audit deficiencies. Number 19. Deficiency: no independent inspection or verification prior to acceptance of delivered property. Number 20. Deficiency: absence of periodic management review or monitoring reports addressing property internal control status. Next slide. Part 1. 15 challenging questions. A mixed format comprehension check, true or false, error spotting, multiple choice, and short scenarios, for self-testing at an advanced level. This final part is a genuine comprehension check. 15 challenging questions in a mix of formats, true or false, spot the error, multiple choice, and short scenarios, designed to test whether you actually understood the material, not just whether you heard it. Next slide. 15 challenging questions. Number 1. Q. True or false? A control system that reduces risk to zero is the standard the ICSPPs holds agencies to. False. The ICSPP's standard is reasonable assurance, not the elimination of risk. Absolute assurance is explicitly outside what internal control can promise. Number 2. Q. Spot the error. Under the ICSPPs, the 4 general objectives of internal control are operations, reporting, compliance, and custodianship. Identify the term that does not belong and supply the correct one. Custodianship is wrong. The 4th objective is safeguarding of assets. Next slide. 15 challenging questions. Number 3. Q. Multiple choice. Which of the following is a preventive, not a detective, control? A. Annual physical count. B. Dual signature requirement before release from the warehouse. C. Relief from accountability process. D. RPCPPE reconciliation. A. B. Dual signature before release stops a problem before it happens. The other 3 all operate after an event has already occurred. Number 4. Q. True or false? Collusion between a custodian and a records officer defeats segregation of duties, but management override does not. False. Both collusion and management override are separately recognized as inherent limitations that can defeat even a well-designed control system. Next slide. 15 challenging questions. Number 5. Q. Spot the error. The head of agency's responsibility for property ends once a property officer is formally designated, transferring full accountability to that officer. What is wrong with this statement? The head of agency's responsibility does not end. It continues in parallel with, not instead of, the designated officer's own personal liability. Number 6. Q. Scenario. A regional office custodian is directed by a superior to release equipment without the required PAR, objects only verbally, then complies. Is the custodian relieved of liability? A. No. Relief from liability requires written notice of the objection before complying. A verbal objection does not shift liability to the superior. Next slide. 15 challenging questions. Number 7. Q. True or false? Inspection and acceptance may be performed by the same unit that subsequently holds custody of the item, as long as different individuals sign each document. False. The function itself, not merely the signatures, must be independent. Combining inspection and custody removes the intended check regardless of who signs what. Number 8. Q. Multiple choice. The inventory committee's core output for the annual physical count is A memo to the head of agency. B. The completed inventory count form and consolidated RPCPPE. C. A verbal report at the year-end meeting. D. An email summary to accounting. A. B. The inventory count form and RPCPPE are the documented outputs required by Commission on Audit Circular Number 2020-006. Next slide. 15 challenging questions. Number 9. Q. Spot the error. An item found at station during the physical count but not previously recorded should be entered into the books immediately upon discovery, without further inquiry. What is the correct procedure? The item must first be investigated, with evidence of ownership and a defensible fair value estimate established. Before it is recognized, it is not booked automatically on discovery. Number 10. Q. True or false? Reconciling the property card against the general ledger is exclusively the accounting officer's responsibility. False. It is a joint responsibility of the property office and the accounting office, functioning as a shared monitoring control. Next slide. 15 challenging questions. Number 11. Q. Scenario. A commission on audit finds the same property-related deficiency repeated across 3 consecutive annual audit reports for 1 LGU. Which internal control component does this most directly indicate has failed? A. Monitoring. Repeated recurrence across audit cycles points to a breakdown in the agency's own follow-through on corrective action, not merely a one-time lapse in a control activity. Number 12. Q. True or false. A small municipality may lawfully forego maintaining internal control over its property on the ground that its income class does not require it. A. False. The internal control and internal audit requirements apply to LGUs regardless of income class or size. Next slide. 15 challenging questions. Number 13. Q. Multiple choice. Which document establishes an individual end user's personal accountability for an item of PPE at the moment of issuance? A. The purchase order. B. The inspection and acceptance report. C. The property acknowledgement receipt. D. The RPCPPEA. C. The PAR, or ICs, depending on the item, is what transfers custody to a specific individual and creates that individual's accountability. Number 14. Q. Spot the error. Semi-expendable items fall below the capitalization threshold, so the agency's property record-keeping obligations do not extend to them. Correct the error. A. Record-keeping obligations extend to all government property regardless of unit value. Low-value items still require a stock card or semi-expendable property card. Next slide. 15 challenging questions. Number 15. Q. True or false. Once a control has been designed and documented, testing whether it is actually followed in practice is optional if no problems have been reported. A. False. Monitoring specifically requires testing operating effectiveness, not just design. A control nobody follows is not a functioning control regardless of whether a problem has yet surfaced. Next slide. End of session 1. Internal control over property and supply management. This concludes the